What if the Social Security check you're counting on could suddenly leave you with more or less money in retirement? Many Americans think Trump's plan means Social Security will simply become tax-free, but the reality is more complicated. There's a hidden tax issue that could affect how much of your benefits you actually keep, and most retirees don't fully understand it. Welcome to American Dream Finance. In this video, we'll break down what the proposal really means, who could benefit, and what you can do now to protect your retirement income. And stay until the end, because the most important strategy isn't waiting for Washington, it's controlling how you take your retirement income. Let me start with a question. What if you could keep more of your Social Security check because the federal government stopped taxing your benefits? For millions of Americans, that sounds like an obvious win. And that's exactly why Trump's proposal to eliminate federal income taxes on Social Security benefits attracted so much attention. But there's a problem. The headline makes this sound much simpler than it really is. First, let's clear up something important. Trump proposed eliminating the federal income tax on Social Security benefits. That does not mean Social Security payroll taxes would disappear. Those are two completely different taxes. The payroll tax is what workers and employers pay while you're working. The tax on Social Security benefits is an income tax that can apply after you start receiving benefits. And as of now, you should not assume that Social Security benefits have simply become tax-free because of Trump's proposal. That's important, because the rules still matter when you're planning your retirement income. So why can Social Security be taxed in the first place? Under current federal rules, your Social Security benefits can become partially taxable when your combined income gets above certain thresholds. And here's where a lot of people get confused. The IRS doesn't simply look at your paycheck or your total Social Security check. For this calculation, 1/2 of your Social Security benefits is added to your other income, including certain tax-exempt interest. For example, imagine you're married and receive $36,000 a year in Social Security benefits. You also take $50,000 from a traditional 401k. That doesn't mean the government automatically taxes your entire $86,000 as Social Security income. Instead, the IRS uses its specific Social Security taxation formula to determine how much of your benefits becomes taxable. At higher income levels, up to 85% of your Social Security benefits can be included in taxable income. And this is another point that needs to be made very clearly.
Up to 85% taxable does not mean the government takes 85% of your Social Security check. If you receive $36,000 in benefits, you are not suddenly paying tax on $30,600 as a tax bill. The 85% is the maximum portion of the benefit that can be included in taxable income. Your actual tax bill depends on your total taxable income, deductions, filing status, and tax bracket. Now here's where the controversy gets interesting. The basic thresholds used for Social Security taxation have been around for decades. The original benefit tax rules were enacted in 1983 and took effect in 1984. Congress expanded the rules again in 1993, but the key thresholds have not been indexed to inflation. That means the dollar amounts themselves haven't risen the way many other Social Security-related figures do. So as Americans' incomes have increased over the decades, more retirees can find themselves inside the Social Security taxation rules. That's one reason the issue feels very different today than it did when the rules were first created. And this is where I think retirees need to look beyond the political headline. The real question isn't simply, should Social Security be tax-free? The bigger question is, if we eliminate this tax, who benefits and how do we replace the revenue? That's because the tax on Social Security benefits isn't just money disappearing into some unrelated tax bucket. A portion of this revenue helps finance Social Security, while another portion supports Medicare's hospital insurance trust fund. The Tax Policy Center has estimated that completely eliminating the federal tax on Social Security benefits could reduce federal revenues by roughly $1.5 trillion over 10 years. And the timing matters. According to the 2026 Social Security Trustees Report, the OASI Trust Fund is projected to have enough reserves to pay 100% of scheduled benefits until the fourth quarter of 2032. After that, continuing program income would cover only about 78% of scheduled benefits under the report's assumptions. So we're not talking about a theoretical problem decades from now. Social Security's finances are already under pressure. That creates a difficult trade-off. On one side, eliminating the tax could give some retirees more money to spend, save, or invest today. On the other side, removing a source of revenue could make Social Security's long-term financing problem worse, unless Congress replaces that money somewhere else. And there's another important detail. Not every retiree would benefit equally from eliminating the tax. Someone with very little income outside Social Security may already owe little or no federal income tax on their benefits. Someone with substantial income from a traditional IRA, 401k, pension, rental property, or continued employment may have much more of their Social Security benefits exposed to taxation. So the biggest dollar benefit from eliminating the tax doesn't necessarily go to the retirees who need the help the most. That's the part that often gets lost in the political debate. A tax cut can sound universal while producing very different results for different households. And that's why I don't think the smartest retirement strategy is to sit around waiting for Washington to decide whether Social Security will become tax-free. Instead, retirees need to understand how their own income sources interact, because here's the uncomfortable truth. Your Social Security benefit is only one piece of your retirement income puzzle. Where the rest of your money comes from can determine how much of that Social Security benefit becomes taxable. A $50,000 withdrawal from a traditional retirement account can have a very different tax impact from $50,000 withdrawn from a properly structured Roth account. That doesn't mean everyone should rush to convert everything to a Roth. It means you need to understand the tax consequences before you need the money. And that's the real problem we're dealing with. It's not simply whether Washington should tax Social Security. It's that millions of Americans enter retirement without understanding how their different income sources interact with Social Security taxation. The political promise is simple: no tax on Social Security. The retirement reality is much more complicated. Before you build your retirement plan around that promise, you need to understand what the current rules actually are, what could change, and what you can control regardless of what Congress does. And that's exactly where we're going next.
Now that we understand the problem, let's move to the part that matters most. What can you actually do about it? Because whether Congress eventually eliminates federal taxes on Social Security or keeps the current rules, you still have control over one very important thing: how you create retirement income. And this is where good retirement planning can make a major difference. The first mistake I see is treating every retirement account as if it were the same. It isn't. Money coming from a traditional 401k or traditional IRA is generally taxable when you withdraw it. Qualified withdrawals from a Roth IRA are generally tax-free. Social Security has its own separate taxation rules. And if you're still working, your wages can create another layer of taxable income. So instead of asking, will Social Security be tax-free under Trump's plan? A better question is, how can I build a retirement income strategy that works even if the rules don't change? Let's start with the simplest step. 1. Know your retirement income sources. Before retirement, write down every source of income you expect to have: Social Security, 401k, traditional IRA, Roth IRA, pension, rental income, part-time work, investment income. Then estimate how much you might need from each source. This gives you something extremely valuable: control. For example, Imagine a married couple receives $40,000 a year from Social Security. They also have $300,000 in a traditional IRA and $150,000 in a Roth IRA. They don't necessarily have to take every dollar they need from the traditional IRA. Depending on their circumstances, they may be able to combine different income sources. That flexibility can help them manage their taxable income from year to year, and that's much more useful than simply hoping Congress changes the law. 2. Be careful with traditional retirement withdrawals. This is especially important once you reach the age when required minimum distributions apply. Traditional retirement accounts can eventually force taxable withdrawals, even if you don't need the money for spending. Those withdrawals can increase your taxable income, and higher taxable income can potentially increase the portion of your Social Security benefits that is subject to federal income tax. So if you're approaching retirement, don't wait until your first RMD arrives to think about taxes. Look several years ahead. You may have opportunities before RMDs begin to manage your future tax burden. That could include strategic withdrawals or, for some households, partial Roth conversions. But there is no universal answer. A Roth conversion itself can create taxable income in the year of the conversion. So the goal isn't simply to convert everything to Roth. The goal is to determine whether a conversion makes sense for your specific tax situation. 4. Use Roth accounts for flexibility. This is one of the biggest advantages of having different types of retirement accounts. Suppose you need an extra $20,000 one year for a major expense. If that entire amount comes from a traditional IRA, it can increase your taxable income. But if you have qualified Roth assets available, that money may be available without federal income tax. That doesn't automatically mean Roth is better than traditional. It means having both can give you more choices. Think of it like having multiple tools in a toolbox. You don't use the hammer for every job. You use the tool that makes sense for the situation. Retirement income works the same way. 5. Don't make your plan based on a political promise. This is probably the most important advice in the entire video. If Congress eventually eliminates federal income taxes on Social Security benefits, great, that could reduce taxes for many retirees. But you shouldn't build your entire retirement strategy around legislation that may change. Tax laws change, presidents change, Congress changes. Your retirement savings are much harder to change once you're already retired. So build your plan around the rules that exist today and treat future tax changes as potential upside, not as something you are guaranteed to receive. 5. Review your plan before retirement. If you're within a few years of retirement, this is the time to run the numbers. Don't wait until your first Social Security check arrives. Look at what your income might look like at different ages. For example, age 62. You might have wages or investment income. Age 67, you might begin receiving Social Security. Age 73 or later, required minimum distributions may become an important part of your taxable income, depending on your age and account type. Your tax situation can look completely different at each stage. That's why retirement planning shouldn't be a one-time decision. It's a process. And if your situation is complicated, consider working with a qualified tax professional or fiduciary financial advisor who can model the numbers with you. Don't just ask them, "How much can I withdraw?" Ask, "How can I withdraw my money while managing my lifetime tax burden?" That's a much better question. Because here's the bigger lesson. If Social Security taxes disappear, you'll benefit from a change in the law. But if they don't disappear, you still need a strategy. And the best strategy is usually not trying to predict Washington. It's creating enough flexibility in your retirement income that you're not dependent on one tax rule going your way. That means understanding your Social Security benefits, understanding your traditional accounts, understanding your Roth accounts, understanding RMDs, and most importantly, understanding how they interact. The goal isn't simply to pay the lowest tax this year. The goal is to create a retirement plan that gives you more control over your money
for many years. And that brings us to the final question. What should you actually do today? Because knowing the rules is useful, but taking action is what can potentially improve your retirement. So, what should you actually do with all of this information? Don't wait for Congress. Don't wait for a new tax law. And don't assume that Social Security will automatically become tax-free. Start with your own numbers. Today, pull out your most recent Social Security statement and your retirement account balances. Write down 3 numbers. How much Social Security could you receive? How much income could come from traditional retirement accounts? How much money do you have in Roth or other potentially tax-free accounts? Then, look at the income you expect to have outside Social Security. If you're married, do this for both spouses. You may discover that your biggest retirement tax risk isn't Social Security itself. It may be the way your other retirement income interacts with it. For example, if most of your retirement savings are sitting in traditional 401ks and IRAs, future withdrawals could create taxable income. That can affect your overall tax bill and potentially increase the taxable portion of your Social Security benefits. If you have a combination of traditional and Roth accounts, you may have more flexibility. And if you're still working and several years away from retirement, this is often the time when you have the most opportunity to plan. You can potentially make contributions strategically. You can evaluate whether Roth conversions make sense. You can think about when to claim Social Security. And you can build a withdrawal strategy before you're forced to make decisions under pressure. But remember, there is no one-size-fits-all retirement strategy. A Roth conversion that makes sense for one household could be a bad move for another. Claiming Social Security early could make sense in one situation and be completely wrong in another. The right answer depends on your age, income, health, savings, tax bracket, spending needs, and how long you expect your retirement to last. So don't copy somebody else's retirement plan just because it worked for them. Build yours around your own numbers. And there's one more thing I want you to remember. The debate over Social Security taxation is bigger than one president or one proposed tax change. It's really a debate about how Americans should fund retirement and how much income retirees should be allowed to keep. Eliminating federal income taxes on Social Security could put more money into some retirees' pockets, but that revenue would have to be replaced somehow if we want to avoid putting additional pressure on Social Security's finances. That's the trade-off. More money for retirees today can mean less revenue for the system tomorrow, unless Congress finds another source of funding. And that's why this isn't a simple good or bad policy question. There are real arguments on both sides. But for you as an individual retiree, there's a practical lesson. Don't make your retirement dependent on a law that hasn't happened yet. Plan using today's rules. Build multiple income sources. Understand how traditional and Roth accounts behave differently. Pay attention to RMDs and review your strategy before retirement rather than after the money starts coming out. If Social Security eventually becomes federally tax-free, you can adjust your plan. If the current rules remain, you'll already be prepared. That's the advantage of having a flexible retirement strategy. You don't have to predict the future. You just need a plan that can survive different versions of it. So, here's your action step. Before the end of this week, take your expected Social Security income and your other retirement income and put them on one page. Then ask yourself, if Social Security remains taxable, what will my tax situation look like? And then ask the opposite. If Social Security becomes tax-free, what would I do with the extra money? Those two questions can completely change the way you think about retirement planning, because the goal isn't to win a political argument. The goal is to keep more of your hard-earned money while creating a retirement income plan you can actually depend on. And that's the real lesson here. Don't wait for Washington to solve your retirement. Build a plan that gives you control, regardless of what Washington does. If you found this helpful, leave a comment and tell me, do you think Social Security benefits should be completely tax-free? And if they were, would you spend the extra money, save it, or invest it? Thanks for watching. I'll see you in the next one.